Yeah, good morning. This is me again with another series on financial independence and, of course, confidence. It appears there's some inconsistency in how we handle money. I'm a strong believer in the percentages of how you handle money. I have something called the 50-30-50 rule. It's typically how you provide your savings and how you use your money. How you manage your money on a daily basis, on a monthly basis, or on an annual basis. So the 50%, number one, 50% basically means you allocate 50% of your income towards essential expenses. These are expenses such as your housing. You have to do that. You have to live somewhere. Utilities, you have to pay for electricity, water. Groceries, you've got to eat. Transportation, you got to go to work, you got to move around, you got to have insurance. When you're ill, you got to have insurance. And of course, you have to pay minimum debt. You have to you have some credit cards you still have to pay. So 50% of your money goes to your needs, and needs is things that you must have. Then 30% goes to your wants. What you want. I want vacation. So dedicate 30% of your income to what I call discretionary spending, or in other words, non-essential items. This is such as like going out, dining out in an expensive restaurant, entertainment, big plays, going to the plays and movies and things like that. Hobbies, you have a hobby, an expensive hobby. You like to travel to expensive, exotic places and other, personal indulgence. So I think you can now organize your money that 30% can go into that. Then 20% has to go to your savings and debt repayment. You have to pay your debt and also you have to save money. So allocate 20% of your income towards savings. This can include emergency fund contribution. This can be money you're putting away for your retirement because you have to get old and you're not going to work the rest of your life. You also need how to pay off some debt beyond minimum payment. Like if you have a credit card and they're telling you pay $20 a month, well, pay $30 a month to bring it down quicker. So these are some 10 items that I believe in and I put down. You may need to know about money. So spend less than you earn. If you earn $1,000, make sure you spend way less than that. Not the other direction. Earn and spend. Earn and spend. So what I mean is, spend less than you earn. Don't spend more than you earn. Create and stick to a budget. A budget will help you look at your income versus what is your expensive. Save and invest regularly. Save your money. The 20% I talked about, save it and also use it for investment. Put it in the stocks. Put it somewhere whereby it generates more money for you at the end of the month and the end of the week, end of the year. Then you have to manage your debt. If you have debt, get rid of the debt or pay for them promptly so that they don't have extra fees. So you don't have incur more money, late fees and things of that nature. So pay your debt responsibly. Then you have to plan for your retirement. This life gets very difficult if you don't have a retirement plan. You work 30 years, and then after 30 years, now you want to maybe, or 40 years, or 50 years. If you start working at 20, then you work until you're 75. Now you want to retire and be at peace. You need to have some reserves somewhere, some money that you put aside. So always, always plan for your retirement. Then practice self assurance by protecting yourself. Please get insurance. It's hard to pay for medication or medicine or medical emergency out of pocket. Always have insurance. Pay for that. Your 20%, pay for that. It is almost a necessity or a need, not a want. Always have insurance for yourself. And if you're having issues, I keep repeating and I keep emphasizing that educate yourself about personal finances. Know how money comes in, how money goes out, especially in your personal need. Then you have to have financial goals. If you don't have financial goals, and if you don't have a budget, then you are in for a rude awakening, a hard fall. Please educate yourself on personal finances, then set your financial goals. Those two go hand in hand, because if you're not educated about finances, how are you going to have a goal? Because you don't know how. Let's say, for example, what is compound interest, or how do you compound your interest on money? So, but I also have another thing. If you're 20 signs to show that you're good with money, what kind of person are you? Why do I know that you're good with money? Because you do financial awareness. You budget yourself, and then you know how to spend your money. You have what is called financial awareness. So basically, financial awareness refers to having a clear understanding of your personal or business finances. This involves being knowledgeable about your income, your expenses, your assets, your liabilities, and overall financial situation. Financial awareness is so essential, because it will help you make informed decisions, setting goals, and managing your finances effectively. So basically, when you're financially aware, you know your income. You understand income, where your income comes from. How many sources of income do you have? Where is it from? Your job? Is it from your investment? Is it from your business or other sources? So you can track your income regularly to know how much money you have available. Be aware of your expenses, including both fixed expenses such as rent and mortgage, utilities and insurance, and variables such as groceries, entertainment, and other discretionary spending. So tracking your expenses helps you identify areas where you can potentially save money. And of course, budget. Create a budget to plan and allocate your income towards different categories of expenses. You don't want, of course, we know there's emergency expenses, but when you budget, you know where your savings, you know where your investments are, and of course, you have to pay your debt repayment. So budgeting will help you prioritize your financial goals and control your spending. So you have to save and invest. I keep doing this. Be conscious of the importance of saving and investing for short term, and also you have to have long term goals. All your goals cannot be short term. All your goals cannot be long term. Such as if you want to build an emergency fund, savings for retirement or investing in assets. All these are issues or matters that can generate returns. So debt management means you understand your debt, including the amount you owe, the interest rates you pay, develop a strategy of managing and paying off your debt to avoid excess interest payments, and of course, you improve your financial health. So set specific measurable achievements such as being your financial aware, which allows you to identify your goals and the steps to achieve them, whether it's buying a house or starting a business or traveling the world. So you have to set specific, measurable, achievable, relevant, and time-bound financial goals. So they have to be specific, the goals, they have to be measurable, they have to be achievable. You don't want to make a goal that you can't achieve. And it has to be relevant. And of course, you have to do it time-bound within a certain period of time. So all that we can only do by having continuous education. Educate yourself about financial matters. Do financial topics learning, such as budgeting, investing, taxes. Another big one, taxes, insurance, retirement planning. Stay informed about financial news and trends that may impact your financial decision on anything you do, because that will allow you to also be understand the risk associated with your financial decisions, such as investment risk, inflation risk, because right now the inflation is so high. The government is trying to bring that inflation to 2%, and of course it's not easy. then you always have risk of unexpected expenses. So take steps to mitigate risks through diversification. So you have your money in a lot of areas. You have to have insurance coverage and emergency preparedness. So of course you can use credit card, but you have to be aware of your credit score all the time. What is your credit score? You review your credit report a minimum of 2 times a year, in the first 6 months and see if there's any changes, and last 6 months and see what's going on. So credit, and then so that you understand your credit history. So you have to understand how credit works, including the factors that impact your credit score and how to improve and maintain good credit. So financial planning will also work hand in hand with credit management, risk management, and financial education. So develop a comprehensive financial plan that aligns with your goals, aligns with your values, aligns with your life circumstances, and regularly review and adjust your plan as needed. That's why I said earlier on that it has to be specific, it has to be measurable, it has to be achievable, it has to be relevant, and it has to be time bound. So you are not going to achieve that if you're living paycheck to paycheck. Struggling to cover basic expenses with each paycheck, it's gonna be difficult. So you have to look for ways how to increase your income. It cannot be possible if you increase your debt. If your debt was 1,000 this month, and then next month it's 2,000, so accumulating high interest debt without a plan for repayment is a disaster. Is a recipe waiting to blow up, explosion. And if you don't have emergency savings, lack of funds for unexpected expenses or emergencies is a no-no. Always try and have those saved up somewhere. And then over reliance on credit cards or loans to cover expenses. If you're relying too much to pay your bills using your credit card or getting a loan to pay your bills, that is a warning sign that you're heading to financial disaster. Ignoring bills, regularly paying or missing bill payments or paying bills late. Number one, if you miss bill payments, it will ruin your credit because your credit bureaus will report that you made a late payment. Besides making a late payment and ruining your credit, you also now have late fees because now you have to pay late fees, which is usually a hefty amount of money. And then if you don't have a financial plan, lacking a budget or a financial plan to guide you on how you're going to spend your money and how you're going to save your money, you have to have a plan, then implement that plan. But the plan has to make sense. It has to be doable. The other way you are heading for financial disaster is overspending on non-essential and discretionary items. You're overspending on going out. You're overspending on buying Gucci bags or designer bags. Well, the moment you're overspending or spending more than you're earning, you are heading to financial ruin. Then the worst actually is no retirement savings. No saving for retirement or neglecting your retirement accounts. If you want to maintain the same lifestyle you're living now, when you're over 70, 80, you have to save for that money. When you're no longer actively employed or work looking and there's no regular or steady income, if you do not have a retirement or right now you're neglecting your retirement accounts, that is a headwind heading your way. Another thing is having low credit score due to missed payments and high credit utilization. Try and have a high credit score so that if an emergency comes and you can at least use your credit card. So have a good credit score. Do not have a poor credit score. Building credit has become the easiest thing now because banks want to lend money so that they can make more money. If they can't lend you money because you have bad credit, the banks are not winning. So fixing credit has become easier because credit is a history. So you can fix it by maintaining a good history, and then your score will go up. So one of the things I was talking about is you budget. You gotta track your expenses. You gotta manage your debt, save and invest, maintain financial education, and monitor your financial goals. To me, those are like really, really fun, excellent. So always remember to have an emergency fund, build an emergency fund. This is very crucial to cover unexpected expenses such as medical emergencies, car repairs. If you're, these things break down. Car repairs, home repairs. When you have a home, you have to fix so many things, or you might even lose your job. Where is the income going to come from? So aim to save at least 3 to 6 months worth of your living expenses so that you have an emergency fund. Insurance coverage, having adequate insurance coverage, including for your health, adequate insurance for your car insurance, adequate insurance from your home insurance. Even if you rent, renter's insurance is very important. You also have to always pay for your disability insurance because this protects you against any significant financial losses resulting from unforeseen circumstances. So, being financially resilient, developing resilience in managing financial challenges involves being adaptable. You have to be resourceful in finding solutions and overcoming setbacks. So, include issues that involve you improving your life. Look for alternative income sources. And of course, by having a part-time job or doing a second job, you have to reduce discretionary expenses. And of course, negotiate payment plan with your creditors. So all this, you have to have advanced planning, whereby you're anticipating potential emergencies and having a plan in place to address those potential emergencies. This will help you minimize the impact on your finances. They may also involve in creating a will. You have to establish powers of attorney or setting up plans for unexpected eventualities. So a lot of us, I know, we have challenges of living paycheck to paycheck. So this is a situation where a person's income is primarily spent on covering immediate expenses, leaving little or no room for savings or unexpected expenses. This can create tremendous financial stress. It will create tremendous financial insecurity because there's no financial cushion. You have nothing to fall back on in a case of emergency or any financial challenges. So the moment you're living paycheck to paycheck, there's little or no savings or emergency funds available to cover unexpected. Or high debt levels are so high, a significant portion of your income is going towards debt, such as credit cards, and loans. If you have loans, things of that nature, then you're living paycheck to paycheck. Then overregularly overdrawing your account, overdrawing your bank account, or frequently incurring overdraft fees due to insufficient funds. Avoid those, because if you get to that level, you're living paycheck to paycheck. Then your late payments, struggling to pay bills on time and often being late payments. Late payments are the worst because they're just making the bill even bigger. If you're supposed to pay $30, but you're late, so now you're added another $30. Now you're supposed to pay $60. Double. You avoid that. And like I tell you before, always contribute to your retirement accounts, because this is a long-term savings for your future, for your retirement. Always have that. And most of all, get a second job so that you have disposable income, so that you have money left over from after covering your essential goods and expenses. So after you paid for everything that you need and want, then you have some money left over. Because if you don't do that, you become vulnerable to emergencies. Without savings, you'll be living paycheck to paycheck. And of course, you're vulnerable to unexpected expenses, such as medical expenses. If your car breaks down, this will lead to even further financial hardship. So try and be ahead of that. Limited financial freedom of living paycheck to paycheck restricts your financial freedom and makes it challenging to pursue long-term goals such as home ownership. If you're living paycheck to paycheck, you don't have freedom to decide that you want to buy a house. It makes it difficult that now you decide that you're going for higher education. It makes it difficult for you to say that, okay, I want to travel. I want to go to Hawaii this year. Then cycle of debt. Without savings, you may resort into borrowing money to cover emergencies, leading to a cycle of debt. So you borrow here to pay here, and then now you have to borrow to pay here. So it's a cycle. You're just in a vicious cycle of borrowing. So this will lead to cycling of debt, then high interest rate and fees will also kick in. Stagnant financial growth is the lack of savings and investment. These will hinder your financial growth and prevents individuals from building wealth and achieving financial independence. The goal is to create wealth, build wealth, and be financially independent. Because if you don't do that, you'll have stress and anxiety. Constant financial stress and anxiety can negatively impact your mental health and overall well-being. So you want to avoid getting to that level. So if you find yourself living paycheck to paycheck, it's essential to take proactive steps to improve your financial situation. Breaking the cycle of living paycheck to paycheck requires commitment. You need to be disciplined, you need to be patient, and by taking proactive steps towards financial stability and doing a long-term planning for your own self. So potential financial issues may require attention and corrective measures may be addressed. So I'm just seeking my brothers, let's be proactive, let's do the right thing, let's save money, let's make more money so that we have money left over for our retirement. That's all I have for today. Thank you all very much. Bye.